Hello everyone, this is Sakir Al-Zahrani and today's project is going to be the small apartment investment. To complete this project, I first input the assumptions as provided for project 3. Then I calculated the loan amount by multiplying the loan to the value ratio by acquisition price. And then I calculated the monthly payment using the PMT Excel function. After that, I calculated the depreciable base by multiplying the depreciable base percentage provided, which is 85%, by the acquisition price. So first step is going to be calculating the loan amount, which is equal to the acquisition price multiply by loan to the value ratio. The loan payment monthly should be calculated by PMT Excel function. We have the rate over here. It's going to be divided by 12. And the number of period and it's going to be multiplied by 12. And here we have the present value or the loan amount, and the period of time is going to be 0. Then close the parentheses. After that, we're gonna calculate the depreciable base, which is equal to the acquisition price multiplied by the depreciable base. And then I started by calculating before tax cash flow. To get the potential gross income, I multiplied the number of units by monthly rent by 12 months for the first year. For the second and the third year, I multiply the previous year PGI by 1 plus the rent growth rate. For the vacancy, I multiply PGI by the vacancy rate of 9% to get the effective gross income. I subtracted the vacancy from the potential gross income, operating the expenses, which include fixed, variable, and reserves. For the first year are as provided in the assumptions. Operating the expenses for year 2 and 3 increased by the growth rates provided in the assumptions by multiplying the previous expense by 1 plus their respective growth rates. To get the total operating expenses, I added the 3 expenses, that is fixed, variable, and reserves. Then I calculated the net operating income by subtracting the total operating expenses from the effective gross income. To get the before tax cash flow, I subtracted the debit service, which is the monthly payments multiplied by 12 from the net operating income. For the GI, which is the potential gross income, I took the number of units multiplied by the rent multiplied by 12. For the second year, I used the previous cell, which is the first year, multiplied by 1 plus the rent growth. Then we lock the numbers down by dollar signs, then we close the parentheses. Same formula would be on the third year. Multiply 1 plus rent growth. There you go. For the second year, for the list vacancy, I used the negative sign to have a positive number at the end. So I'm just gonna use the previous first year of the potential gross income multiplied by the vacancy rates. And then we lock the numbers down. Same for the second year. Negative multiply by same as well for the third year. Multiply by for the EGI, the effective gross income, I used the function sum, and then I calculated the first column. Same as well for the second year, sum function, highlighting, close the parentheses. Sum to calculate the fixed expenses, we're just going to copy the assumption above, which is given here, fixed expenses amount. After that, we're just going to copy the previous cell and then multiply by 1 plus the fixed expenses growth, and then we lock the numbers down. Same as well formula for the year 3. Multiply by 1 plus the expenses, the fixed expenses growth, and then we lock the numbers down by the $sign. For the second, the variable expenses, the second expense would be given also. So we're just gonna copy this cell, $5,000, and then multiply by 1 plus the variable expenses growth, and then we lock the by $signs. Multiply by 1 plus the reserves will be given also in the assumptions. So I'm gonna just copy the cell. For the second year, we're just gonna multiply the first year by 1 plus the variable expenses, the reserve count, then we lock the numbers down. For the TOE, use the function sum. Just like that. Same as well. Sum, then we drag these numbers down. Sum, for the list date surface, I use the loan monthly payments. I use the $signs too, multiplying by 12. Now we should be able to drag this down, and we can also add for the taxable income part. I proceed to calculate the taxable income. Net operating income and reserves is as already calculated in the previous step. so I reference that. Interest paid per year is calculated using CU NIPMT Excel function. To calculate the depreciation, I divided the previous calculated depreciable base by the cost recovery period of 27.5 as provided under the assumptions. Then finally I calculated the taxable income and reserves to net operating income and subtract both interest and depreciation. For the net operating income, I used the previous column. Same for the second column. And the third column too. For the plus reserves is going to be equal to the previous cells of reserves. Same for the rest. It's going to be same as well. The less interest, I use the function CU NIPMT and then I took the rate and then I lock the numbers down by $sign divided by 12, comma, and then we're gonna have the tail long term and then lock it down and then multiply by 12 and then the loan amount and lock it down too. After that we're gonna have the period started from 1 to 12 ending up with 0. For the second column would be the same process, same formula, CU and IPMT, and then I go to the rate and then lock it down, and then I multiplied, so I divided by 12, and we're gonna have the long term, which is 30, and lock it down. Multiplying by 12, and then we're gonna have the loan amount and then lock it down. We're gonna have period starting from 13 and 24 ending up with 0. And then we're gonna change it to the $sign. Same as well for the third column would be CUM IPM PMT. The rate would be 5% in this case, and then we lock the number down, divided by 12, and then we're gonna have the rate, sorry, the long term, and then we lock it down, and then multiply by 12, and then we're gonna use the long term and then lock it down. For the period, we're gonna start from 25 to 36, and then we'll close the parentheses, then we'll change it to the dollar sign. For the list depreciation, I use the function negative to have at the end a positive number, divided by 27.5, and then choose the dollar sign, and we can drag it down or just copy the previous cell. After tax cash flow, I use the function sum, and then I selected all first column, same process for the second column, and same function sum, select all, and the third one would be the same sum, the next part is to calculate after tax cash flow. Before tax cash flow is as previously calculated, so I reference that. To calculate the tax impact, I multiply the taxable income by the investor tax rates on income of 33% as provided. Then to get the after tax cash flow, I deducted the tax impact from the before tax cash flow. Before tax cash flow is going to be same previous assumption, and for the tax impact I used the negative sample, and the taxable income multiplied by the investors' tax rate on income, which is 33%. And we lock down the numbers by $sign. Here is going to be negative multiply by 33%. We lock the down numbers, and then we change it to the $sign. And for the last column, it would be the same, negative taxable income multiply by 33, and we lock down the numbers, change it to the $sign. After tax cash flow, it would be this amount right here, adding up this amount. And for the second column, it would be same process, just gonna add up even for the third column. And that's how we calculate after tax cash flow. The next part is going to be calculating the tax equity reservation. And I started by calculating the future selling price by multiplying the equity price by 1 plus appreciation rate given, which is 10%. And then I calculated the selling price by multiplying the future sales price by the selling costs rate of 6%. And then I subtracted that from the future sales price to get the net proceeds from the sale. To get the loan balance after 3 years, I used the PV Excel function, and then I subtracted 3 from 30 term years, and multiplied that by 12 months. And finally, to get the before tax equity reservation, I deducted the loan balance from the net proceeds from the sale. To calculate the future sales price, we're going to need the acquisition price, multiplying by 1 plus the appreciation, and for the list selling costs, we're going to use the negative sign, and then the previous amount multiply by 6%, the net proceeds from the sale is going to be first sale plus the second one. And to calculate the list loan balance, I use the PV function. And then I calculated the rate, which is the mortgage interest rate, divided by 12, and the loan term. Minus 3, close the parentheses, and then multiplying by 12, and the loan payment, the loan monthly payment. Then we close the parentheses. And for the BTER, I used the previous cell for the net proceeds from sale plus adding up the list loan balance. The next step is to calculate the capital gain. Net proceeds from the sale are as previously calculated. The original basis is the acquisition price as provided under the assumptions, so I reference that. To get the depreciation taken, I added the depreciation over the 3 years, improvement expenditure is as given under the assumption. To get the adjusted basis, I subtracted the depreciation taken from the original basis, and then as improvement expenditure, finally to calculate the capital gain. I deducted the adjusted basis from the net proceeds from the sale. To calculate the net proceeds from the sales, I'm just going to drag the number for the net proceeds from the sale, and then here for the original basis we're going to use the previous sale. For the assumptions given, it's supposed to be the acquisition price, and for the less depreciation taken, we're just going to use the function of sum, and then calculate the depreciation from cell D to cell F. And for the plus improvement and expenditure, is going to be equal to the previous amount of the costs of improvements, which is 6,000. And for the adjust, we're going to use the function sum, and then we're going to go to the cell $75. For the capital gain, we're going to use minus the adjust basis. For the capital gain is going to be my next step to calculate the capital gain tax. I started by separating the two portions, which is the appreciation and the depreciation, taken portion. The depreciation taken portion is called. The next step is going to be to calculate the capital gain tax. I started by separating the two portions, the appreciation and the depreciation taken portion. The depreciation taken portion is as calculated previously, so to get the tax on it, I multiplied by the depreciation taken rate of 25% as given under the assumptions. To get the appreciation portion, I have deducted the depreciation. I deducted the depreciation taken the amount from the capital gain amount, and then multiplied that by the appreciation tax rate of 15% to get the amount of tax on it. To get the total tax, I added both taxes. In the part of the appreciation portion, I'm going to use the less depreciation taken, adding up 78, which is the capital gain, and then to calculate the tax it will be D81 multiplying and over here we will be using negative sample, and then we can use this depreciation thing. For the tax, we can use the A2 multiplying okay. After that, we're gonna calculate the total, which is going to be plus we're just going to be adding up. Next part, for the investment column, we can use parentheses and then use the acquisition price minus the loan amount to the loan to the value ratio, or the loan amount, and then close the parentheses, and then we're gonna add up the cost of improvements. The final step is the decision criterion. I started by calculating the initial equity, which is the acquisition price less than the amount, and then adds the improvement expenditure to calculate after-tax cash flows. For the third year, I add after-tax cash flow periodic and before tax equity reservation, and then subtract the tax on the capital gain. To calculate the present value factors, I used its formula. To calculate present value benefits, I multiply it after tax cash flows by the present value factors. To get the total present value, I add the present value benefits and the initial investment. To calculate the NPV, I use the NPV Excel function to calculate the IRR, and I use the IRR Excel function. After tax cash flow periodic, I am going to the first year and have the previous assumption. After tax cash flow, and then for the second year, it's going to be second column, and for the third year, it'll be this amount. To calculate the first, to calculate the after-tax periodic for the first year, we'll use the assumption, the previous assumption over here, and it's going to be the same for the second year and the third year. The second column would be this amount right here. So we're just going to put it down, and then I'm going to use the negative sample, and then we're going to have the total amount of the tax. After that, we can use for the year 0, I'm just going to copy and paste this column, and first year would be this plus this plus this column. Or we can drag it down over here. For the second year, we can use the same amount, this one plus this one plus this one. And for the third year, we're going to count from here plus this amount plus this amount. For the PV factor, I use the formula, which is 1 divided by, open parentheses, 1 plus the investor's required rate of return. And then we're just going to close it down by dollar signs. Same as here. We're going to use the same formula. 1 divided by, open parentheses, 1 plus dollar sign D dollar sign 29, close parentheses, and then we're going to use multiply by 2. And for the third year, I'm going to use 1 divided by 1 plus 1, 1 plus and we close the parentheses to 1 by 3. Okay, we should calculate the P total benefits now. And that should be calculated. Now we should be able to calculate this, multiplying by the after-tax total for the first year. Same as the second column. Multiply by for the third column. Should be using this, multiplying by this total. The total present value for the total PV, we're going to use the sum function. Then we're going to calculate this and those amounts. Then we close the parentheses. For the NPV value, I use the function NPV and then I use the investor required rates of return and the after tax then we close the parentheses. Plus this value the IRR. I use the IRR function and then I calculated this value then we drag it down until this value, then we close the parentheses. For the conclusion, in this case of scenario, I think the investor should invest due to the fact that the investment has a higher IRR of 21% compared to the investor required return of 10%. The project had a positive NPV of 23,660 and 47 cents.